Hello, I'm Phil Dobbie, and welcome to the latest in our series of 4 podcasts looking at the key principles of thriving in the face of uncertainty with Michael Fingland, the CEO of Vantage Performance. Now, we've looked at some guiding principles, understanding your unique selling point, the need for some strong financial management. We've done all of that. We've looked at strategy, what that entails, including understanding which products are important and the need to continue to develop new products or new capabilities. So now, Michael Fingland, capital management. And we've talked about how we need to keep track of money with the 3-way forecasts and a 13-week cash flow forecast. Now, I'm sure you're going to tell me when we start looking at capital that we should be doing more with less. And to which the reaction is always going to be, well, look, I feel like I'm working hard now. How can I do that and keep my business running in a sustainable way? I mean, there's got to be a balance here, hasn't there?
Yeah, it certainly does. And welcome again, Phil. The key to capital management is efficient management of your capital. Right. So when we go into a situation where the business is either dealing with rapid growth issues and that's causing some concerns in the business, or whether they're going through a challenging period where cash flow is really tight because of declining earnings or sales, we need to look at how we can utilise the internal working capital or the internal capital in the business a lot more efficiently, rather than having to rely on borrowing more money or tapping the equity markets or raising private equity. So it's always a key focus, and there's always, I haven't come across a situation yet where we haven't been able to improve cash flow by 10% just by looking at better uses of assets, better uses of their banking facilities, and just smarter restructuring techniques to enable us to sweat what we call the internal working capital before then looking at the need for external sources of cash.
Right. So this is very different, isn't it, from the idea that, look, let's screw down suppliers on price, or let's make sure everyone works 1.5 times as long per week. I mean, because that is the sort of unsustainable approach.
It is, and 99% of consultants will go in there and just start slashing and burning, and most management teams will do the same. Yeah. Now, sometimes if a business has come off a cataclysmic event and they've lost 30% of revenue overnight, well, then you do need to make some rapid adjustments to your cost base. But it's always the last resort, in our view, because it does cause more harm than good if it's not done as part of a complete restructure plan. And there are always ways to release cash from the business just by looking where the inefficiencies are inside the business. So stock management, renegotiating with suppliers to rationalise your supply chain. We've got a client at the moment that has 750 odd suppliers. Now they should only have maybe 250, 300. So there's a huge amount of benefit by rationalising that supply chain down to the 250, 300 mark, and we'll be able to negotiate better terms, better payment terms, better pricing, because the remaining suppliers will get much more volume. So just that alone is going to generate significant cash for this client that we've just started working with. So that's one example. Debtors is often an area where clients get lazy, or their finance team gets lazy. The whole production chain, if it's a manufacturing business, there are always inefficiencies in there that can turn into cash. Looking at selling non-core assets, or surplus assets, there's always a lot of situations where assets have accumulated over time that aren't really that critical to the business, and when it comes to preserving the core business or looking at, do we leave that property on the balance sheet? It's a nice to have, don't really need it, but that $3 or $5 or $20 million, could we actually invest that into another part of the business that's going to generate a much better return? So and use that cash from that sale to repair the balance sheet and fund some of this restructure work that needs to happen. So looking at some of those sacred cows and those nice to haves on the balance sheet and taking the hard line, if we have to do this to protect the core, well, we'd rather have a business at the end of the day rather than a few nice assets on the balance sheet that we'll have to sell anyway if the business doesn't survive. So
you've talked about cash quite a bit there. I mean, you mentioned cash quite a lot. I mean, are we really talking about cash? I mean, is it important that it makes sense, obviously, that you want to run an efficient business so there's money that you can plow into other parts, the growth areas of the business. Or do you need to keep cash in hand as well? Because, I mean, these days I would have thought, look, if you want to grow, get a loan. I mean, do you really need to have cash sitting in the bank? Isn't it doing nothing while it's there?
You do need to have a base level of surplus cash for emergencies, for the typical month-to-month cycles and fluctuations of your cash flow. So you do need to maintain a base level and have an emergency buffer. But where you've got situations where cash is tight and you've got lazy assets sitting on the balance sheet, that's where you need to look at, well, can we actually do more with that asset by converting it into cash, using it to pay down debt if we've got too much debt and interest rates and interest costs and repayment levels are too high for where the business is at right now. And even looking at things like rationalising your product range, particularly where a company has gone through rapid growth. We see this quite often and far too often, is where a company's ended up with far too many products or services, and it's really not making much margin on a whole range of those products, yet it's taking up a lot of room in the warehouses, and that's tying up cash in the warehouse. So if we can't get the margins for those products up to an acceptable level through price increases or taking costs out of the business, then often the situation of rationalising the product range but down by 10 to 30% means we've got less stock, less throughput, less purchases, and that converts into cash very quickly. So often part of a turnaround strategy is to pull the business back, rationalise it, simplify it, because that generates a lot of cash flow, which you can then use to shield the business and also divert and surplus cash into other areas of the business that are going to generate better returns.
Yeah. Look, Michael, you don't need to tell me about companies with too many products. I used to work in the telecommunications industry, and they seem to produce, if you haven't created 20 products by the end of the day, then you're not doing your job properly, sadly. So what about dividends? I mean, the idea that you want to keep shareholders happy, you want to pay dividends, but on the other side, you want to keep the business happy and keep the bank happy as well. How do you get that balance right? I mean, because if you start saying, look, we're not going to pay dividends, that's sending a bad signal, isn't it?
Not necessarily. In this called new age where things have changed permanently since the GFC, everyone's looking for effective, efficient capital management. And if that means we're putting dividends on hold for 12 months to protect the business, to put that former income stream into a new service line or into a new part of the business that's going to generate a lot more value, then as long as it's sold effectively to the stakeholder group, the shareholders, the banks, etc., then you'll get a lot of support for that, because at the end of the day, their shares will go up in value if diverting dividends to a capital enhancement project is going to deliver better returns in the medium term. So it depends on what sort of shareholder base you've got. So if you're a listed company and you've got a lot of short-term investors, well, then they'll be looking for not so much long-term investment players. They'll be looking for dividends, etc., etc. So it depends on, you need to look at your shareholder base and try and understand whether you've got shareholders who want dividends or shareholders who are in there for the long haul and want capital value return. But the overriding factor that's different now than what it was 5-6 years ago is people are looking for efficient and effective capital management a lot more than ever before, and companies are no longer afraid to put dividends on hold or to slash dividends, but you need to have a plan to demonstrate that the alternative use of those funds is going to deliver better value.
Now, I wonder also whether the mentality is changing on insourcing versus outsourcing. I mean, there used to be a school of thought, and I guess it's still around, that, look, if you want to create efficiencies, outsource as much as possible to people who are the experts in a particular field. But, I mean, that can create inefficiencies as well. How do you get the balance right on that?
You can, but it's very difficult to get it right. And so a lot of companies have gone down that path because so many management consultants and et cetera have recommended it as the way to reduce costs, et cetera. But often you end up in inefficiencies, and where you're looking at if volumes have come off quite a way and you're looking at having to make redundancies in your core business, which costs money and et cetera, an often productive initiative to deploy is to actually bring that outsourcing of whatever you were doing back in-house, and then utilising those staff that are currently sitting idle because the work's not there, and then bring that work back in house and using those staff to now undertake that work. So it avoids having to make those restructures or redundancies, which has an obvious impact on morale and culture.
Yeah.
So that's,
not to mention the cost of actually paying those redundancies as well. But I think you're right. Actually saying, hey, look, we're bringing some of this stuff in. We're going against the trend because we want to keep you in jobs. I mean, that means you're going to tap into all of that extra effort that people put into a job
right.
when they feel as though they belong.
It can be a cultural enhancement tool, and also particularly where quality control has been eroded by outsourcing, and that's the hidden danger of outsourcing is you lose direct control over quality, and then all you've got is the threat of taking the contract off the contractor if they don't keep up with quality. But in the meantime, your customers are complaining about product control. So it does resolve or can resolve a lot of those issues and help protect the business.
All right. Now, what about your relationship with the bank in all of this? They seem like an important player, but I'm just wondering whether it's the sort of relationship you can work on, because, I mean, aren't banks largely driven by formulas? So if you're managing your cash, they're going to be happy. But do you need to go beyond that? Do you need to get to know your bank manager these days, or are they just completely driven by spreadsheets and you're wasting your time?
No, definitely. No matter what cycle you're in, you need to have a very strong relationship with your bank manager or managers, depending on how many banks you've got. Critical and more critical than ever before. They are looking for, as I mentioned before, effective capital management plans in place. So a lot of the things we've just talked about are questions now the banks will be asking of their clients. So again, we talked previously about how do you stand out from the crowd to make yourself more accessible for credit. It's having some of these things when you do present to your financiers about requests for more cash or whatever it might be, demonstrating that you've actually gone through the process of analysing all of these types of initiatives, whether they work or not. The fact that you've actually gone through and assessed them all improves the confidence that the bank has got in your management team, and helps build that stronger relationship which you need. So when you do need to rely on support from your financiers, those that have got a strong relationship with their bank will always fare better.
Right. Now, this is a final question for you then, Michael. And this is a bit of a how long is a piece of string question. But if you get all of this right, if if a business suddenly gets sharp at how it deals with capital management, how does that flow through to the bottom line in terms of profitability for the business, for example? Are we seeing what sort of spike do we generally tend to see?
Oh, you can recapture a few percentage points on the margin, both gross margin and net margin. So the obvious savings in interest costs, but that's usually at the margin, so a little bit of interest saving reductions. But it's what you then do with that cash by redeploying it back into the parts of the business that are growing well, or where there's an opportunity to take on market share, and that can deliver substantial gross profit enhancement. Because in any business there's areas pockets where it's really hard to compete. There's others where you've got new opportunities to grow and leverage your brand, but you're capital constrained. So the biggest savings that come out of managing your cash really effectively is the redeployment of resources into other areas where there's growth opportunities, and it can transform the business in a matter of months.
Right. So long as you know what those growth opportunities are and you can leverage them, of course. You've got to get that right. But you also...
And that's where the strategy bit came into
a
couple of sessions ago, around working out where those opportunities are, how much cash we need to do to capitalise on those opportunities. Have we got the right skills in-house? That brings in the people side, which we'll talk about later, to effectively execute those new strategies with a properly capitalised plan.
Right. Well, that is a good segue, because we will talk about people next year. I love the way this all comes together. So next time we'll talk about people, very important in every business and often not forgotten about, but perhaps not treated with the respect in terms of what it means for the bottom line of a business. So let's talk about that next time. Appreciate your time, Michael.
Sounds good. Thanks, Phil.